Order blocks and fair value gaps. A fair value gap, or FVG, is a temporary price discrepancy between a coin or token's current price and its fair value price. It's usually caused by an imbalance between buyers and sellers following a big price move in either direction. So how do you spot a fair value gap on a price chart? A fair value gap is essentially a triple candle pattern. You can see here, 1, 2, 3, where the high of one candle doesn't fully overlap with the low of the next, creating this gap. This gap results in an unadjusted area on a price chart. You can see it here in blue, formed by these 3 candles, which in turn often draws the price action back towards the gap after it's formed, before the price action then continues again along its prior trajectory, as you can see here on this bearish example. Fair value gaps create imbalances between supply and demand, which affords potential trading opportunities in the direction of the imbalance. As if you know, most times out of 10, fair value gaps will be revisited by the price action at some point. That's foresight you can integrate into your trading strategy. To understand why markets like to get their fair value gaps filled, you have to understand who benefits from the price action returning to said gaps to fill them. Exchanges make money when a buy or sell order gets filled, as the exchange receives a fee for that transaction. So exchanges want fair value gaps to be filled because they don't get paid those fees when an order is left unfulfilled. Likewise, big money, or rather whales, billionaires or large institutions, essentially market makers, always want to get their orders filled inherently. So when a fair value gap appears, these market makers will often actively attempt to manipulate the market with additional buy and sell orders to essentially promote the price action to return and revisit any fair value gaps that exist, so they, the big money, can get their orders filled before the price action, of course, resumes its previous direction and continues on its way. Moving to a live chart now, let's take a look at what fair value gaps look like in practice. Now, obviously you can spot these gaps yourself by identifying the triple candle pattern I mentioned earlier. You can see one here, this huge moves form this gap. However, thankfully in TradingView, there are fair value gap indicators that can do the spotting for you. Today I'm using the generic fair value gaps indicator by Algo. You can see it here. Just disable and enable, just so you can see the gaps appear and disappear. Of course, there is a paid version with more functionality, and there are many other fair value gap indicators to choose from, including another by Algo called the Smart Money Concepts indicator, which also includes a fair value gap function. But you'll have to experiment and see which one of those indicators you prefer, as different indicators can produce slightly different results depending on how they've been coded. So with the free fair value gap indicator by Algo enabled on my price chart, you can see the fair value gaps are now visible, with the green gaps being buy orders that haven't been filled, which you can see here, and then the red gaps, which you can see down here, and there's a few more here, and here, and here, and here, where sell orders haven't been filled. Using these bullish fair value gaps as an example, the bullish ones are in green, remember, and knowing that it is in the best interest of market makers for the price to revisit these areas before the price action potentially continues higher. If I'm thinking of entering a long trade to capitalize off this uptrend, these fair value gaps might prove an excellent place to catch any swing lows, if they of course align with other support levels to create potential confluence for my trade entry. So again, not willing to enter a trade just on one idea. This is clearly a resistance line here, which the price action has broken through, creating this gap. Therefore, it is quite likely that the price action will come back at least down to this area before continuing higher. The gap, of course, giving me extra confidence that this support line may be revisited over the next few days. But there is admittedly a subtlety here. Fair value gaps do not act exclusively like support or resistance levels. They are simply visible imbalances that the price must revisit to correct, acting like a magnet for the price action. But there is nothing stopping the price action barreling straight through a fair value gap once it's revisited, like so. So you must use fair value gaps in combination with other signals and indicators to truly capitalize on the knowledge of where they are. So for example, when faced with bullish momentum, which you can of course see in this current price action, bearish orders within a fair value gap, you can see a little red fair value gap here, can actually supercharge a rally, as these seller orders sitting in this gap sometimes will provide liquidity for long traders who are desperately trying to enter the market. As you can see here, it works and the price breaks out with gusto. So you need to consider the impact a gap being filled will have on the price action in different contexts. As I said, this small bearish fair value gap was insufficient to stop this bullish momentum and in fact contributed to this uptrend. Also, sometimes several days or weeks will pass before a gap gets filled, so don't sit around waiting for the price action to come back down if it's now 100% higher than where the gap first appeared. You can see here, of course, the price action is way above these gaps, so they may not be filled for a while. So when planning trades, you want to look, of course, to see if any gaps have been formed and how they might impact the success of your trade, as understanding the dynamics of liquidity will always give you an edge. But treat fair value gaps like support and resistance at your peril, as not all fair value gaps are created equal. Understanding how to identify which fair value gaps are the most profitable, though, can be tricky. So here are 5 tips to help you focus on the most relevant fair value gaps to trade off. Number 1. To ensure that a fair value gap has a high chance of success, it needs to remain what's called unmitigated, which means not tested. And so whenever you see a fair value gap on a chart, you need to make sure that it hasn't been retested by the price action yet, because the effectiveness of the fair value gap decreases once the price action touches it for the first time. For example, if you see a fair value gap that forms, but you also notice that the price has already retested it, then it's arguably no longer an effective fair value gap. Another important thing to note is that the price shouldn't retrace too deeply to the point where it closes below the gap, as if it does, then the fair value gap is also, in this case, invalidated. So the best fair value gap entry is when the price action hasn't retested it yet and the gap remains unmitigated. Number 2, whenever you spot multiple fair value gaps on one setup, such as in this example, always prefer the ones with large sizes. Large fair value gaps, such as this one, almost always work better compared to smaller ones because they represent a stronger imbalance between buyers and sellers. This means they are more likely to act as stronger areas of support or resistance. Moving on to number 3. If you found a setup with multiple fair value gaps that are about the same size and none stand out particularly, you'll need to filter them out based on their position, and the ones you use will be the fair value gaps located in the lower portion of the move, which usually has a higher chance of success. To do this more precisely, you'll need a tool on a charting platform like TradingView. You can use the GAN box tool. You then go to settings and set the price levels to 0, 0.5 and 1. And to use the tool, you simply drag it from the swing low to the swing high of the movement that contains the multiple fair value gaps. This line in the middle then separates the fair value gaps, and you should only focus on the gaps located in the bottom area, ignoring the ones on the upper level. Same thing for shorts. Drag the tool from the swing high to the swing low and only focus on the gaps located in the top area. Number 4. A type of setup you should absolutely avoid is when a fair value gap forms as the price approaches a major key level. For example, let's say you spot a bullish fair value gap forming, but when you look back, you notice that there's a major resistance level above. So it's best to ignore this fair value gap because key levels could cause the price action to be rejected and reverse, which may invalidate the fair value gap. Moving on to number 5. Fair value gaps that form after a break of structure are gold, and if you manage to spot these types of fair value gaps, they have one of the highest win rates compared to other setups. You can spot these types of fair value gaps when they form near and after a break of structure, as the price action has a higher likelihood of reacting to this gap and bouncing from it compared to others. We have a video on break of structure and what it is, or rather BOSS if you're unfamiliar, so be sure to check that out. As we've now established, simply identifying fair value gaps when they appear is only half the strategy, as you need to learn to ignore the irrelevant ones and only focus on the fair value gaps that are more likely to behave like support and resistance levels, as those are the ones you want to trade. And those helpful fair value gaps are typically the ones which have confluence with other bullish ideas, like a fair value gap, for example, that forms alongside the 0.618 fib retracement level, as an example. That being said, on the flip side, another concept, order blocks, unlike fair value gaps, do not represent an imbalance between buyers and sellers, but simply a group of buyers and sellers looking to enter the market. And unlike fair value gaps, which represent market imbalances, most order blocks do act more naturally like support and resistance, where, as we've established, only some fair value gaps act like support and resistance. So let's take a quick look at order blocks as well. Order blocks are simply supply and demand zones where market participants place large buy or sell orders, which can influence the price action. Since a large volume order can cause sharp price changes, typically these buy or sell orders, buy represented in green here and sell represented in red, these are divided into smaller blocks, order blocks, which are then executed bit by bit as the liquidity of counter orders slowly accumulates. Order blocks essentially give you an insight into investor interest in certain price levels, which you can then use to trade off. Unlike fair value gaps, which we were just looking at, order blocks do act as great support and resistance levels. For example, the price action will bounce off an order block acting as support, or stop as the price action meets resistance when an order block is overhead. Simply put, the best entries and exits are typically where the order blocks are. Moving back now to a live chart, like with the fair value gap we were discussing earlier, which I'll just switch off. There we go, no more fair value gaps. I'll be using the Algo order block detector indicator, accessible in TradingView for free. So let's just enable that order block detector by Algo, and there we go. And you can see the order blocks will appear. There's a bearish one above, and there's a big green one here following this bullish run up. There is obviously a paid version of this indicator with more features, and as before, the Smart Money Concepts indicator by Algo also has, like with the fair value gap functionality, also has the order block detection features as well. So feel free to experiment with both, as I said, to see which you prefer. Also, just a word of note, I obviously disabled the fair value gaps indicator at the start, but if we re-enable it, it can kind of help us kind of figure out which order blocks are going to be the ones to look at, because we've got then a fair value gap plus an order block here and a fair value gap plus an order block here. However, these two levels, not so much. So this level here, which has both a fair value gap and an order block, and these two levels obviously are more important than these two. So this is just another technique you can use to try and figure out which order blocks or which fair value gaps are going to be the most effective. So as you can see, there is currently an order block here, which the price action is now retesting. And as it proceeds lower, these orders will eventually get filled. But you would expect, of course, a bounce off this level because that's quite a significant amount of orders. Plus, we have a key trend line here creating confluence. If you're thinking of trying to get in on this bullish momentum, setting an order within this block or at this or these support levels would be a good idea. But how do order blocks form? Well, let's have a quick look. So this is November the 5th, the Tuesday, November the 5th, the election in the United States, which prompted Bitcoin to make some bullish moves after the results were announced. The price action, as a result, follows Bitcoin and it breaks through this resistance line. And when traders see the price action breaking through this resistance line, they think, right, I'm going to try and enter on the SR flip when the resistance level becomes support. And this order block, as a result, forms. And then when the price action does retest, there's enough orders there to propel the price action higher. And then the same process happens here. This is a key resistance level for the price action. And the second it breaks through, everyone is like, right, I want to get on this. So orders begin to form in this area, which is why the order block is currently acting as support to the price action. Now, if the price action does bounce off here, as it probably will, and it comes up here, we have a bearish order block. So the expectation would be that we have a bit of a move down here. These buy orders propel the price action higher, but then we get quite a lot of selling activity to maybe come back down at least a little bit, maybe to this level, and then start trying to eat up some of those orders before progressing higher. But obviously, if I was going to enter a trade here, I'm going to take profits here, because this bullish order block is acting as support and this bearish order block is acting as resistance. So this would be the move, this would be the trade, and that would be 47% give or take. So to keep it simple, the best entry for a long trade is within a green order block, and the best price target or short entry point is within a red or bearish order block. But here's another thing to keep in mind. If you see the price action within an order block, say a bearish order block, so let's say the price action comes down into this bullish green order block, the orders get filled, creating bullish momentum, and then we hit this red order block and selling activity resumes. But right around this time, Bitcoin starts to make some crazy bullish moves, which forces the whole market higher. Therefore, the price keeps attacking this bearish order block. And then you start seeing perhaps divergence out of the price action. The RSI perhaps gets oversold. Indications perhaps that the price action is going to bust through this zone, and this liquidity is going to be eaten up by people trying to get in to the market. So you must use order blocks in combination with other signals to ensure you are staying one step ahead of market moves. So don't just presume a bearish order block will result in lower prices without first consulting wider market signals to create a bullish or bearish case for a trade. Like with any trading approach, you need to use Confluence and not just one single idea to ensure you are maximizing the probabilities in your favor. But order blocks do provide clear insight into where the liquidity sits and how much of it there is, which can turn traditional support and resistance levels into clear points of entries and exits, allowing you to see what other traders are thinking, which is the whole game. Today we've looked at two concepts, order blocks and fair value gaps, which when used together can give you an insight into what market makers and other traders are thinking, providing opportunities to trade and hopefully improving your success rate. The important thing to remember though is that fair value gaps are created when a coin or token's current price differs from its fair value price, usually caused by an imbalance between buyers and sellers after a strong price move in either direction, leaving lots of buy or sell orders remaining unfilled, something big money and exchanges don't like. But it's important to remember that just because a fair value gap is printed, it doesn't mean the price action will immediately return to it, but fair value gaps will always be areas of interest for the price action to revisit. And when observed in combination with order blocks, which act more like support and resistance levels, you can start to assess the likelihood or not that a gap will get filled. But it is in both the exchanges and the market makers' interest for the price action to revisit these gaps, which is an insight you can use. And by comparison, order blocks are simply great places to put buy or sell orders, providing more defined support and resistance levels where the price action is likely to bounce. That's it for now. Catch you in the next one.